Hello, my name is Tyler Vernon, Chief Executive Officer at Biltmore Capital Advisors. When most people think about investing, they think about two categories, stocks and bonds. Over many, many years, college, universities, and some pension plans have introduced a third part of their diversified portfolios called alternative investments. Our Chief Investment Officer here at Biltmore Capital, Dr. Don Chambers, is going to talk a little bit about alternative investments and how they can be used within diversified portfolios.
Hi, I'm Don Chambers. I'm Chief Investment Officer at Biltmore Capital Advisors. I'm here today to talk a little bit about alternative investments. First of all, most people define alternative investments as not being stocks and bonds. So that's a good starting point, is to realize that buying and holding stocks and bonds is traditional investments. But what exactly are alternative investments? Well, at least from a major institutional perspective, we tend to think of alternative investments as including hedge funds, managed futures, private equity, maybe structured products. So why should an investor consider alternative investments as part of their portfolio? And the primary answer to that is diversification. Alternative investments can also offer tremendous growth potential. A lot of major endowments and institutions their portfolios have performed very well due to being in alternative investments. But I think the primary motivation to investing in alternative investments is to provide diversification. Especially in today's environment, alternative investments are important. The reason I say that is because the two major alternatives to being in alternative investments are being in the stock market and being in the bond market. The stock market is at all-time highs. We've enjoyed a tremendous bull market over the past 6+ years, and it's traditional that such bull markets, such as we've experienced in equities, don't tend to last that long. So one should not necessarily completely avoid equities, but it makes a good argument that some of the money that might ordinarily be invested in equities might better be invested in alternatives. By the same token, the bond market has experienced rather good returns over the past few years, and interest rates are undoubtedly at historic lows. Cash returns are almost zero, and long-term interest rates are only 1 or 2%. So the downside in bonds is pretty enormous. Now, I'm not opposed to investments allocations in equities and bonds, but I think the argument is that alternative investments that have a reasonable probability of performing well, even if the equity market turns poorly or if interest rates rise, are a wise part of a portfolio.